The roof estimate says $40,000. So you call the brokerage and you ask them to send $40,000 from the traditional retirement account, and 3 days later, the money is sitting in checking, and it feels like the transaction is finished. It is not finished. It finishes in April. I am Susan, and today we are going to run the whole thing. One couple, one roof, one withdrawal. I am going to show you why $40,000 of roof requires $46,293 of withdrawal, what the tax on that actually comes to, and then I'm going to show you the version of the same roof that costs $3,522 less in tax. Same house, same contractor, same money in the contractor's hand. The only thing that changes is the date. Let me set up the couple, and I want to be honest that this is a household I built to run numbers on. It is not a real family, but every rule I am applying to them is a real rule for the year 2026. He is 70, she is 68, they file jointly. Between them, Social Security pays $46,800 a year, which is $3,900 a month for the household. On top of that, they pull $18,000 a year out of the traditional retirement account for ordinary living. No pension, no wages, no tax-free interest. They take the standard deduction, like most people their age. Now, before the roof, look at what their tax year looks like. This part surprises people. Their deductions stack up like this. The standard deduction for a couple filing jointly is $32,200. Because both of them are over 65, they each add another $1,650, so that is $3,300 more. And then there is the temporary senior deduction created in 2025, $6,000 per person over 65, which is another $12,000 for the two of them. I want to flag that word temporary out loud, because that one is written to expire after the 2028 tax year. Add it up, and this couple can absorb $47,500 before a single dollar is taxed. Against that, in a normal year, they report $18,000 of withdrawal plus a small slice of their Social Security. Their federal income tax comes to zero. Not almost zero. Zero. That is the ground we are standing on. Now the roof fails. Here is the first thing almost everybody gets wrong, and it is not a small thing. Money coming out of a traditional retirement account is not money you already own free and clear. It is money you and the government have been co-owning since the year you deferred the tax on it. When you take $40,000 out, $40,000 is added to your income for the year, and the tax bill on it does not show up until you file. So if you pull exactly $40,000 and hand all of it to the roofer, you have not covered the roof. You have covered the roof and left yourself a bill. Run it. With the extra $40,000, this couple reports $58,000 of withdrawal. Their taxable Social Security jumps. Their taxable income lands at $48,290, and their federal tax comes to $5,299. They went from $0 to $5,299 because of one phone call. And that is the number if they only pull 40. To actually keep $40,000 in hand after the tax, they have to pull $46,293, and the tax on that is $6,293. $6,293 on a $40,000 roof. That is 13.6% of the withdrawal, gone to federal tax alone. Now here is the part I really want you to sit with, because this is the mechanism, and once you see it, you will recognize it in every large withdrawal you ever make. This couple is in the 12% bracket. 12% is what the chart says. But watch what happens to each extra dollar they pull. Social Security is not automatically taxable. How much of it becomes taxable depends on a figure called provisional income, which is your other income plus half of your Social Security. Below $32,000 for a couple, none of the benefit is taxable. Between $32,000 and $44,000, up to half of it can be pulled in. Above $44,000, up to 85% of the benefit can be pulled in. and here is the detail that matters more than any other in this episode. Those two thresholds, $32,000 and $44,000, were written into law in the 1980s and 90s, and they have never been adjusted for inflation, not once. Everything else in the tax code moves with prices every year. These two numbers sit exactly where they were put. So when this couple pulls an extra dollar out of the retirement account, two things happen at the same time. That dollar is taxable. And it also drags about 85 cents of their Social Security into the taxable pile behind it. $1 of withdrawal creates $1.85 of taxable income. At the 12% rate, that is 22.2 cents of tax on a single dollar. I measured it rather than guessed. Starting from a $30,000 withdrawal, adding $1,000 more raises their federal tax by $222. 22.2% in the middle of what the chart calls the 12% bracket. Some people call this the tax torpedo. I do not love the drama in the name, but the arithmetic is real, and it is the reason a big withdrawal is more expensive than the bracket table suggests. Now let me give you the good news, because there are two pieces of it and both are useful. First piece. Look at the ladder of what the withdrawal actually costs, step by step. $10,000 of extra withdrawal costs this couple zero in federal tax, because they are still tucked under that $47,500 wall of deductions. $20,000 costs $1,129. $30,000 costs $3,079. $40,000 costs $5,299. Notice the shape of that. It is not a straight line. The first $10,000 is free, and then the cost per dollar climbs fast. That shape is the whole strategy of this episode, and we are coming back to it in a minute. Before I leave that ladder, let me show you what it means for a smaller job, because most household repairs are not roofs. Say it is the kitchen instead, and the number is $15,000. Run the same household through it. The first $10,000 of that withdrawal sits under their wall of deductions and generates no federal tax at all. The last $5,000 starts the climb. Their tax on a $15,000 withdrawal comes to a few $100s, not a few thousand. So there is a size below which this whole conversation does not apply to you, and for this couple, that size is somewhere around $10,000 a year on top of what they already pull. Knowing roughly where your own free step ends is worth more than any tip I can give you, because it tells you when to stop worrying and just take the money. Second piece of good news. Medicare. A lot of you have heard that a big withdrawal can raise your Medicare premiums 2 years later, and that is true. It is a surcharge called the Income-Related Monthly Adjustment Amount, and for 2026, it starts when a couple's income goes above $218,000. This couple, even after pulling $46,000, lands at about $104,000. That is not close. They are clear. So the Medicare light on this decision is green, and I want to say that plainly because the fear of that surcharge stops people from taking money they genuinely need. It is a real threshold. It is just a long way from where this household is standing. So, $6,293 in federal tax to fix the roof and no Medicare consequence. Now let me show you the cheaper version. The tax year is a calendar year. It closes on the 31st of December, and a brand new one opens the next morning with a fresh set of deductions and a fresh run up through the brackets. Most roof jobs of this size are not paid in one lump anyway. There is a deposit and there is a final payment. And most contractors, if you ask them plainly in September, will tell you what their schedule looks like in December and January. So instead of one withdrawal, this couple takes two. $21,385 in late December, and the same amount in the first week of January. The tax on the December piece is $1,385. The tax on the January piece is $1,385 because the new year gives them that whole wall of deductions again. $2,771 total, against $6,293. That is $3,522 saved, and the two withdrawals are 3 weeks apart. Nothing about the roof changed. The contractor gets the same money. The couple keeps $3,522 that would otherwise have been federal tax purely because the second half of the money landed on the other side of a date. Now I owe you 3 cautions, because I would rather you hear them from me than find them in April. The first one. Everything I just said applies to people who are past 59 and a half. If you are younger than that, a withdrawal from a traditional retirement account generally carries a 10% early distribution penalty on top of the income tax. On a $40,000 withdrawal, that is $4,000 extra, and it changes this decision completely. The second one, and this is the piece I hear repeated wrong most often. There is an exception that lets you take money from an individual retirement account for a home purchase without that 10% penalty. It is capped at $10,000 for your lifetime, and it is for a first-time home buyer. It is not for fixing the house you already live in. Re-roofing your own home does not qualify for it. If somebody has told you that retirement money comes out penalty-free for home repairs, they were thinking of a different rule. The third one. Every figure in this episode is federal. Your state may take a piece as well, and states differ wildly on how they treat retirement withdrawals. Some do not tax them at all. Some do. That is a one-line phone call to whoever prepares your return, and it is worth making before you pick the date. And one more practical note, which is really about cash flow rather than tax. If you split the withdrawal, the money for the January half is still sitting in the retirement account in December. Make sure the contractor's payment schedule and your withdrawal schedule actually line up, in writing, before you plan around it. A $3,500 tax saving is not worth a fight with a roofer in the middle of winter. One more thing worth saying before the summary, because a few of you are already thinking it. This entire episode assumes the traditional retirement account is the only place the money can come from. For a lot of households, it is not. If there is cash sitting in a savings account, that money has already been taxed and pulling it costs nothing extra at all, which beats every trick in this episode. The order you take money in is its own subject, and I'm not going to squeeze it in here, but if you have more than one place to pull from, the date is the second question. The first question is which account? Here is the whole episode in one line. The withdrawal is not the cost. The withdrawal plus the tax it drags behind it is the cost, and the calendar is the only part of that you get to control for free. So if there is a big bill coming, do not start by asking how much you need. Start by asking how much of it can wait 3 weeks. If you want me to run this for your own numbers, put your Social Security total and the size of the bill in the comments, and I will show you where your ladder turns expensive. Run your numbers. Know you're on track.